Alright, let's move on to the actual entries. In these examples, I'm actually going to be making two different sets of entries. I'm going to be recording the period entry. That is the thing that has happened during the period which is going to cause the later adjustment. And then I'm going to be moving on to the adjusting entry. So let's start with this example. On December 1st, Yip and Snip Pet Grooming is going to prepay $6,000 for 3 months' rent. This prepayment is going to cover the months of December through February. So this is a period entry. How will we put this on the books? Let's go through our 5 steps. Firstly, what accounts are being affected? Well, what are we purchasing? We're purchasing prepaid rent. And how are we paying for it? We're assuming that we are paying in cash. That's what happens when you prepay. What type of accounts are these? They are both assets. Are they increasing or decreasing? Well, after we make this prepayment, the amount of prepaid rent that our company has on the books is going to be going up. And since we are sending cash out to our landlord to prepay, it's going to be going down. And because they're both assets, we know that assets increase on the debit side and decrease on the credit side. So this entry during the period to put the prepaid rent on the books in the first place would be on December 1st. We debited prepaid rent for the entire amount of the purchase, $6,000, and we credited cash for that same amount. At the end of the period, we're going to have to make an adjustment because some of this rent is going to expire. So on December 31st, December's portion of the prepayment expires, and Yip and Snip has to recognize the expense in the period which it occurred due to that gap matching principle. So we have to record the rent expense for December on December's books. Well, what accounts are being affected? I just said one of them, rent expense. What other account is being affected? We're going to have less prepaid rent on our books because one of the months that we prepaid for has passed. So that is going to be our second account being affected. What type of accounts are they? Well, rent expense is an expense, and prepaid rent, we just found out, was an asset. Are they increasing or decreasing? Rent expense tracks how much we paid for rent during the period, and since this is expiring, it's going to be going up. Prepaid rent, the amount of rent we have in advance on our books, is going to be decreasing because some of it is expiring. Expenses increase with a debit, and assets decrease with a credit. So, our adjusting entry at the end of the month on December 31st is going to be a debit to rent expense for the amount that is expiring. How much is expiring? Well, we can figure it out fairly simply. All you do is you take the original amount of prepayment that you had in the first place and divide it by the number of periods that you prepaid for. So we prepaid $6,000 up front. This is for 3 months, December through February. And if we prepaid $6,000 for 3 months, well, we divide that out. That means $2,000 per month, essentially. That is how much expense we're going to recognize at the end of the month. And the credit is going to be the prepaid rent for that same amount, $2,000. Let's do another period entry. This one is for the cash purchase of supplies. So on December 1st, Yip and Snip is going to buy $4,000 worth of supplies. We're going to assume that these are the only supplies they're going to have on their books after they make the purchase. What accounts are being affected? What are we buying? How are we paying for it? Well, we're buying supplies and we are paying in cash. Both of these accounts are assets. Supplies on our books is going to be increasing because we're purchasing more supplies, and since we're paying in cash, our bank account is going to be going down. And assets always increase on the debit side and decrease on the credit side. So the journal entry to record this cash purchase of supplies is going to be a debit to supplies for the amount that we paid for the supplies, which is $4,000, and a credit to cash for that same amount. How are we going to adjust for supplies? Well, it would be crazy monotonous if every time you use a supply you had to take that off your books as an expense. Like if you ran a pen out of ink, imagine having to go to an accountant and say, okay, you got to take 50 cents of our supplies off the books because I just ran this pen out of ink. No one wants to make that many entries. So the way that companies do it is at the end of each period, someone has to go out and do a physical count of the supplies that are on hand, as they call it. Typically there's a storage room. Someone will go in, take account of everything that is in that supply storage room and figure out what its value is. That's the value of supplies on hand at period's end. Well, your books are going to say you have a certain amount from all the purchases you made. So if you go and you take the amount that is on your books, what you had to start the period, and you subtract out what you have left at the end of the period, that tells you how much you used during the period. So to make an adjustment for supplies used during the period, Snip would have sent out someone to do a physical count of their supplies, and that person would have come up with $2,500 in this example. Snip has $2,500 worth of supplies left in their storage at the end of December. Well, they bought 4,000 at the beginning of December, which means we've expended some supplies. Therefore, one of the accounts being affected has to be supplies expense. We've used up supplies. And the other account being affected has to be supplies itself because we used them. We don't have as much left on the books. What type of accounts are these? Supplies expense is an expense. Supplies is an asset. Supplies expense tracks how much supplies we've used during the period. Well, it's got to be going up. And supplies is how many unused supplies we have that can be used later on. Well, we used some of them, so that has to be going down. Expenses increase with a debit. Assets decrease with a credit. So the adjusting entry to record Snip's expenditure for supplies within the month of December is going to be a debit to supplies expense for the difference between what we had on the books and what our physical count revealed. 4,000 minus 2,500 means that they used $1,500 worth of supplies. So we're going to put that on the books. We're also going to decrease the value of our supplies by crediting that asset account for the same $1,500. On December 1st, Snip is going to purchase a haircutting/shampooing machine for $1,000 cash. How do we record this cash purchase of equipment? What are we buying? How are we paying for it? We're buying equipment. We are paying in cash. The amount of equipment that we have is going to be contained within an asset account. Cash is also an asset. And that amount of equipment we have is going to be increasing, while the amount of cash we have, since we're paying out cash to acquire this equipment, is going to be decreasing. And they're both assets, and we know that assets go up with a debit and down with a credit. So for the cash purchase of this haircutting and shampooing machine, Snip is going to record a December 1st entry that debits equipment for the cost of this machine, which was $1,000, and credits cash for that same amount. Now that Snip has this piece of equipment, they have to figure out some way to track its lost value, right? Sure, they bought this piece of equipment for $1,000, but it's not going to be worth $1,000 for forever. Everything loses value. Not everything. Most things lose value over time. This piece of equipment is going to be one of them. So to figure out a way that we can reduce its value in a fair manner, we have to come up with a few what they call estimates. The first one is, how long are we going to use it for? And that is this asset's useful life. So you can track that chronologically. We're going to have this asset for so many years, or you can track it in production. We're going to have this asset for so many different haircuts. It doesn't matter if you use time or if you use production amount. Either or, you have to figure out how much use you're going to get out of this. Secondly, you need to figure out what you think you can get for that asset when you are done using it. Can we sell it? Can we scrap it? Is there something that we can get back at the end when our time using this particular asset is done? And they call that its residual, or sometimes called salvage value. Those two estimates you need to make, and after you have those estimates, you need to come up with a methodology for decreasing the value over time. There are a lot of different approved methods for removing the value from an asset. The method for removing the value of an asset that I want you guys to work with right now is called straight line depreciation, and that means in a straight line, evenly. Every month, every quarter, every year, depending on what period we use, we're going to remove an equal amount of value from this asset. So we're going to say something like, okay, this shampooing machine that we have, let's take away $80 of its value every period. There's a methodology to get there, a little calculation. We're going to see that on the next slide. But what you need for this slide is a thing called the gap historical cost principle. And what that states is you can't actually take the value right away from that asset's account. You always have to keep the asset on your books for its entire life at its purchase price or its historical cost. To track that loss in value, you need to create a separate account. And that account is going to be called accumulated depreciation. And it is a contra account. What exactly does contra account mean? Well, the word contra very literally means in opposition of. What this means is it's going, buying stuff increases its value. What's the opposite of that? Decreasing the value. So a contra account is tied to another account, and it's going to reduce that asset's value over time. So let's adjust for some depreciation right here. On December 31st, Yip and Snip is going to adjust the books to record the amount of depreciation recognized on this equipment. They're going to do so using that straight line method. They've made their estimates. They think that this machine is going to have a 4-year useful life, and its residual value, the amount of money we're going to be able to get for at the end of the machine's life, is $40. Let's record our entry. What accounts are being affected? Well, this is a necessary cost of business. We have to have equipment to be able to do our job. And anytime something's a necessary cost of your business that you are going to incur every period, it is by definition an expense. In this case, it's an expense for depreciation. The other account that is going to be used is that contra account, which tracks the amount of value lost on this particular piece of equipment. That is our accumulated depreciation account. What types of accounts are these? Depreciation expense is an expense. Accumulated depreciation is a contra account, and it is a contra account which is tied to an asset, which means it is a contra asset, something that reduces an asset's value. Are these accounts increasing or decreasing? Well, depreciation expense, like all expense accounts, tracks how much expense we had for something during the period. Since we're depreciating this, it's losing more value. Our expense account has to be going up. Contra asset tracks how much value equipment has lost. Well, this has lost more value at the end of this period than it had beforehand, so that is also going up. Expenses increase with a debit. And the key for figuring out what's a debit or a credit for a contra account is you look at what type of account it's tied to, and it works opposite. So this is a contra asset. We know assets go up with a debit, down with a credit. But a contra account that works opposite is going to work the other way, which means it's going to go down with a debit and up with a credit. To make our adjusting entry on December 31st, we know we are going to start off by debiting depreciation expense. But for how much? Well, that's when we're going to have to use the straight line formula. And the straight line formula starts with something called the depreciable base, which is the historical cost minus the residual value. Historical cost of this asset when we purchased it cost $1,000. Its residual value, given in the information, is $40, which means we need to take $960 worth of value away from this asset over the life of the asset. Well, let's multiply that difference by 1 over its useful life. The useful life of this asset is 4 years. So we're going to multiply that by 1/4. And then we're going to multiply that by the number of periods that we have over 12. This is a pretty easy monthly depreciation, but some companies don't adjust at the end of every month. Sometimes they adjust quarterly, sometimes they adjust annually. So the number of periods isn't always going to be 1, but in this example it is because we're recording these monthly. So 1,000 minus 40, and if you're putting it in a calculator, in parentheses, times 1 over useful life, 1/4, times the number of periods being depreciated over 12, which is 1/12. Multiply that out and you get 20. Accumulated depreciation is also going to get credited for that same $20. We adjusted for equipment depreciation. We recognize that $20 in expense. Next up, we have the receipt of advance payment for future services. So on December 1st, Yip and Snip is going to sign a $6,000 contract with a local police force to provide monthly grooming services for their canine unit, and this contract is going to last 1 year. Well, what accounts are being affected when we sign this contract and receive advance payment? We're receiving this payment now, which means one of the accounts being affected has to be cash. Even though we're going to do a job for them, we can't record it as revenue because we haven't actually met the performance obligation. We've got the money up front, but we haven't groomed any dogs in this canine unit. We owe them something. We owe them work. And when you owe someone performance, it is a liability account called unearned revenue. So cash is an asset, unearned revenue is a liability. Are they increasing or decreasing? Well, we're getting the cash. That means that's going up. But we also owe more work. We have a greater liability. So that is also going up. Assets increase with a debit. Liabilities increase with a credit. So on December 1st, when we make the period entry to record the advanced payment that we were getting for these services we're going to provide in the future, we're going to debit cash for that $6,000 and we're going to credit unearned revenue for that same amount. Now that our contract is signed and we've received that advance payment, over the life of the contract, we are going to meet our performance obligations. We are going to groom the dogs in this police force's canine unit. And as we meet those obligations, we have to adjust our books to reflect the fact that we don't owe as much work as we used to, and we earned some of this money that we were paid in advance. So on December 31st, Yip and Snip needs to adjust its book to recognize, in this case, 1 month's revenue earned on our 1-year $6,000 canine unit contract. What accounts are going to be affected here? Well, the first is going to be unearned revenue. We've done some of the performance that we are obligated to do for this canine unit, which means we owe less. So we need to change our books to reflect the fact that we don't owe as much service to this particular entity as we did before. And since we no longer owe it and we actually earned it, the other account that is being affected is our service revenue account, which tracks our actual earned revenues during the period. What type of accounts are they? Unearned revenue is a liability. Service revenue is a revenue. Are these accounts increasing or decreasing? Like I said, we owe less work now that we've performed 1 month's worth of performance obligations for this canine unit. So our liability to them has to be going down. And service revenue, which tracks the amount of revenue we've actually earned by fulfilling those obligations, has to be going up. What side do these accounts increase or decrease on? Well, liabilities go down with a debit, while revenues go up with a credit. So our adjusting entry to recognize revenues actually earned on this contract for which we were paid in advance is going to be a debit to unearned revenue. How much is this debit going to be for? Well, there's a lot of different ways that you can do this, but for right now, let's do the easiest way. We're going to recognize it evenly. The total compensation of the contract was for $6,000. That is how much we were paid in advance. It is a 1-year contract, and we're recognizing this monthly. So that means the number of months in this contract's life is going to be 12. Well, if we recognize it evenly over the entire contract, that means that we're going to recognize $500 each month. And we credit service revenue for that same $500 as we adjust for these contract revenues that have actually been earned. Here is a period entry for the payment of salaries in cash. On December 28th, Yip and Snip pays its employees $1,500 for 5 days that they have worked during the period. So they worked all these days during the period, and they're going to pay them in the same period in which those salaries were earned by our employees. So we have to recognize that expense. It'll be a debit to salaries expense, and since we're actually paying them, it's going to be a credit to cash. Salaries expense is an expense account. Cash is an asset. Are these accounts increasing or decreasing? Well, the amount we paid in salaries to our employees is going to be going up, while our cash bank account is going to be going down. And expenses increase with a debit, and assets decrease with a credit. So the normal period entry for the payment of salaries, which were actually earned within the period that you are paying them, is always a debit to salaries expense and a credit to cash. If, however, at the end of the period you have days within that period where your employees worked and actually earned those salaries, but they won't be paid for them until the following period, you need to make an adjustment. So on December 31st, Yip and Snip makes an adjustment for salaries earned but not yet paid to its employees. They have worked one day during December, which they won't be paid for until January. So what accounts are going to be affected here? Well, we have to have our expenses on our books in the period in which our employees actually worked. And they worked that one day during December, even though they're not getting paid to January. So we have to put the expense for that one day's worth of salary on December's books. But we're not actually paying it until January, which means we owe something. We owe our employees money for the day that they actually worked. Even if we decided not to open on January 1st, we would still have to pay our employees for that one day that they worked, which means we need to put that liability on the books. And that is a payable. What is the payable for? It's for employee salary. So we're going to call it salaries payable. What type of accounts are these? Salaries expense is an expense account. Salaries payable is a liability. Are they increasing or decreasing? Well, we're putting more expense on our books in December because our employees worked this one extra day. We need to increase our expense to reflect the fact that they worked that one day during December. And the amount of money that we owe our employees after we make this entry is also going to be going up. And expenses increase with a debit and liabilities increase with a credit. So the adjusting entry to recognize this one day that they have worked during the period is going to be a debit to salaries expense. For how much? Well, we can figure that out by taking their pay during a normal period and multiplying it by the portion of a normal period that they actually worked. If you recall from the period entry that we did on the last slide, these employees typically make $1,500 for a 5-day work week. Well, how much would they make each day then? We can take that $1,500 and we can multiply it by the number of days worked over the number of days in a normal period. They've worked one day. Their normal pay period is for every 5 work days, which means it's got to be 1/5 of what they typically make for this one day, and that is $300. So we're going to debit salaries expense for $300 and credit salaries payable for that same $300. We adjusted for accrued salaries owed to our employees. Next up, we have a bank loan. And in a bank loan, you are making yourself liable to pay something. You have to pay the bank back for the money that you borrowed. But you're also receiving the cash at the time that you're borrowing. That's why you're taking out the loan in the first place. So let's say that on December 1st, Yip and Snip is taking out a $10,000 loan. They have 2 years to repay it, and no bank is going to just give them $10,000 now and take $10,000 back later. As we all know from financing cars and houses and even your student loans, you have to pay interest, a little something extra to make it worth their time to let you borrow the money. So this bank is charging Yip and Snip 6% interest on this loan. Yip and Snip is going to make quarterly payments. Not uncommon in the business world to have payments due every 3 months, 6 months, a year. I know in your personal life you always have a monthly payment, but the same is not true for businesses. So we need to figure out what we have to do to put the signing of this loan on our books. Well, what accounts are being affected? The first is cash. We're receiving this $10,000 from the local bank. The second one is the liability, which records the fact that you owe the bank money. And that as a liability is going to end in payable, and they call it notes payable. Notes payable is the account which tracks money that you are borrowing from a financial institution. So accounts payable is things that you buy for the normal course of business. Buying inventory to resell, buying supplies so your company can use them, etc. Notes payable is like financing. And in this case, since we're financing through a bank loan, we're going to use notes payable instead of accounts payable. Cash is an asset. Notes payable is a liability. The amount of cash we have is going to be going up. That's why we're taking out the loan, to have more cash. But the amount of money that we owe to lending institutions for money that we have borrowed is also going to be going up. And assets increase with a debit and decrease, and liabilities increase with a credit. So on December 1st, when we record the period entry to put this note on the books, we're going to debit cash for $10,000 and we're going to credit notes payable for that same amount. We signed a note for a bank loan. At the end of the period, if you have outstanding loans from a lending institution, or if you owe your credit card company money, any of that kind of stuff, you're going to owe them interest. And that interest is going to be accumulated during the period, even if you're making a payment in the future. So you need to put that interest expense on the books in the period which it was actually added to your bill. On December 31st, this 6% 2-year $10,000 loan that Yip and Snip took out for a bank is going to have some interest tacked onto it. What accounts are going to be affected? Well, interest expense is going to be one of them. We have to record the expense in the period in which our company actually incurred it. This expense got added to this loan during December, even though we're making quarterly payments. The other account that is going to be affected is interest payable. We know we owe this interest to the bank. We're going to put that liability on our books. Speaking of, what type of accounts are these? Interest expense is an expense. Interest payable is a liability. Are they increasing or decreasing? Well, our interest expense is going to be going up because we incurred more expense from interest accumulating on our loans during the month. And the amount of interest that we owe to banks after we make this adjustment is also going to be going up because we're deeper in debt right now. Expenses increase with a debit, liabilities increase with a credit. So we have our adjusting entry on December 31st, which is going to recognize December's portion of interest expense. For how much? Well, let's use the standard interest formula, which is principal times rate times time. Our principal carrying amount is how much principal we still owe on this note at the time we are accruing this interest. It was a $10,000 note when we signed it, and we have not made any payments thus far, which means we still owe them the full $10,000 in principal. Our interest rate is stated as 6%, or 0.06 for your calculations. Please don't multiply by 6. And that interest rate is called APR, and it stands for annual percentage rate. That is 6% per year, not per month, and we're only adjusting for 1 month. So let's take that rate and multiply it by 1/12, and we'll convert it from yearly down to monthly. So if we have 10,000 times 0.06 times 1/12, that comes out to be 50, which means $50 in interest is getting added on to our loan, and we need to put that on our books. So we're going to debit interest expense for 50. We're going to credit interest payable for that same 50 as we adjust our books for accrued interest on this bank loan. Next up, we're going to record a contract for future services, but this time the payment's deferred. What I mean by that is we're going to sign a contract, and we're going to do our work on that contract. And at some point in the future, after we've satisfied a certain amount of performance obligations, we're actually going to get paid for that contract. So December 1st, Yip and Snip is hired by the local racetrack to care for horses for the next 2 months. And they are getting paid in full $3,000, but they're not getting paid until those 2 months have expired. So what is our period entry to put this contract with deferred payment on the books on December 1st when we sign the contract if we're not getting paid until 2 months in the future? Well, what's happening here? Nothing of substance is changing hands. We can't record any services because we haven't met any obligations yet at the time that we're signing this contract on December 1st. We can't put any cash on the books because we're not getting paid until the end. They don't owe us anything because we haven't started performing services. It's not like we did half the job and we can go and try to get half the money. We haven't done anything on this yet. Nothing is changing our financial position right now. And because nothing is changing in your financial position for the signing of a contract where the services are going to be provided in the future and the payment is also going to happen in the future, there isn't an entry required. You don't have to put one on the books. However, that being said, here's something that I like to do when I come across this situation. I record what is called a memorandum entry, and I simply put in the date and memo underneath so you know it is a memorandum entry. And in the bottom, in the description of it, I write what happened. There's no accounts. There's no numbers because nothing changed hands. But if someone's going back and looking through the books, they will see, okay, this is the day we signed it, and this is the amount we expect to get in the future. So my memo here would be signed a 2 months, $3,000 contract with the local racetrack. And the reason I like to put a memorandum entry in is because we're going to have to make adjustments still. We signed this contract on December 1st. It is now December 31st, and we're going to assume that we performed all of our obligations that we were supposed to over the period. We need to adjust our books to accrue for revenues that we have earned because we met those obligations, but we've not yet been paid for. Well, what account is going to be affected first? We did the work. And because we did the work, even if this racetrack said on December 1st, we don't want you to do January's portion of this 2-month contract, well, they're still going to pay us for December, right? That just makes sense. We did what we did. They have to pay us regardless, which means they owe us something now. And since they owe us something, that is an account receivable. We also met those obligations within December, which means we have to record the revenue within December. So the second entry here is going to be service revenue. What type of accounts are these? AR, accounts receivable, is an asset. Service revenue is a revenue account. The amount of money owed to our company by outside parties is going to increase after we adjust our books because now this racetrack owes us money. And the amount of actual services that we provided during December that's showing on our books is also going to increase after this adjustment. What side do these change on? Well, assets go up with a debit and revenues go up with a credit. So the adjusting entry to recognize this is going to start with a debit to accounts receivable. For how much? Again, there's a lot of different methodologies you could possibly have to recognize revenues on a contract. Let's keep this simple for right now. And let's just assume that all of our performance obligations are going to be met evenly over the entire life of the contract, which means if we take the original contract amount, which was $3,000, and multiply it by the number of periods that we are accruing or recognizing revenue for over the number of periods in the contract, we should get the amount of expense we can recognize during the period. This was a 2-month contract. We signed it on December 1st for the months of December and January, which means we've earned 1 period's worth. So, in other words, we can recognize half of the revenues because we've done half of the obligation we were supposed to, 1 month out of 2. Which means if we're recognizing half of these revenues, we are going to recognize $1,500 worth. So the journal entry is a debit to accounts receivable for $1,500 and a credit to service revenue for $1,500. We adjusted for our accrued contract revenues.